Now, as we all know, India has a vast informal sector and there were very few avenues back in time to raise unsecured loans. But now that is changing. We know that there are a raft of fintech firms. They've sprung up. They're offering all kinds of convenience to help the informal sector get access to credit. And we're meeting one such here on Startup Central today. We're talking about a company that identifies itself as a lending company. It offers quick access to business loans to micro, small and medium enterprises, and they call themselves SMEcorner. The latest about them, this micro-lending startup, is that they've backed $30 million to disburse 1,500 crore rupees in loans. That's the plan. Samir Bhatia is here to tell us about it. Founder and CEO of SMEcorner. Great to have you with us and congratulations on this latest round of funding. Where does that leave your entire funding situation now?
No, we are happy to have raised this money. I think right now, markets are difficult and we are happy to have investors have the faith in us to actually, and bankers actually lend us this kind of money.
Yeah.
The money is always good.
No, but what's the total kitty that you're sitting on right now?
Well, this money that we raised is the money that we have, that we will lend out.
So you've disbursed everything else that you raised ahead of this?
Yeah, we have. We have actually disbursed everything.
How much have you disbursed so far?
So we've disbursed about
Since you got your license in 2018?
About 550 crores is what we have disbursed so far to about 8,000 borrowers. And we will use this money to disburse another 1,000 odd crores. So but
I find it interesting that you're raising equity at one level, but you're also raising debt. So it's interesting that you raise debt to give out more debt. I don't know how that works as a model.
But that's a classic model, right?
It is?
I mean, you have to leverage your equity if you want returns
in
for
these
your
times.
investors. For us, it's been good. Honestly, we've been able to raise debt from good lending institutions. I mean, we have debt from leading institutions like HDFC Bank, like SIDBI. Okay, we've Northern Arc. We have good institutions lending us money, and frankly, it's been good for us. So.
And you've jumped in with a certain amount of investment. Is that debt or equity?
Myself, personally, it's all equity.
It's all equity, huh?
It's all equity, yes. You have to put your money where your mouth is, so I think that's always good.
Yes.
And I have strong belief that the sector is great.
Yeah.
I have total faith in the sector. I think it's a great opportunity, and also,
But you made a switch because back in 2015 when you started as a marketplace, and then 2017 you applied for a license. Why did that switch happen?
So I started as a marketplace. We said, hey, there are so many lenders already in the business. Why be one more lender? Why not be somebody who can actually provide the access? So we set up a great platform, built a great algorithm that would actually acquire, filter customers, match the borrowers with the lenders. And we started actually, doing that pre-underwriting and giving the pre-cooked loans to banks and institutions. And one thing that came out was, hey, every time we got a really small borrower, banks somehow were not interested, and we had to actually chase them to ask them that, would you like to do this loan? And so me and my team, we sat together and we said, why not just do it ourselves? Why are we actually, if there is such a big gap in the market, where every time there is a small loan, nobody is interested in giving it, and they're not interested because A, the DNA is such that, they want to do large loans, and second, unless they deploy a lot of technology and they are nimble and they operate with a good low cost structure, it's not economical for them to give a loan. So we jumped in, and I'm really glad we did because it's been great going for us.
But the pace at which you're talking about of disbursal of loans, technology is the big enabler on that count,
Very big.
But then there are enough players coming in to do exactly that.
So I'm glad there are, because honestly, this whole segment that we cater to, there is not enough research data available, but we believe 5-10% of it is actually financed through formal channels. The balance is all financed through the informal channel, and it's really good that formal channel is coming in because this segment needs formalized lending, because more formalized lending means more data with the bureaus, and more data with the bureaus means that more people can lend and give more to the sector. So there is a lot. I always like it when there are more players. It keeps us on our toes, and it also helps the sector as a whole to be more robust and perform better.
Right. So tell me about the lenders and your core. You've kind of stuck to shopkeepers. They could be in the garments business. They could be chemists. Tell me about them. What is their average profile since the time that you came in? How has that changed a little bit, if at all?
Yeah. So we are agnostic to the sector largely. I mean, we would like to lend to anybody who is doing a small business. It could be an eatery, could be a chemist shop, could be a laundry, could be just about anyone. And Kirana stores are large, and retail, like you said, retail garments, uniforms, clothes is a very large. So we're agnostic, but we lend to kind of wide swath of such, such borrowers. Average turnover is about, ranges from 12 lakhs to about 1 crore of rupees. Just depends on the size and the scale of their business.
So what's a non-negotiable when it comes to these lenders? What do you ensure that without this, there's no go?
Yeah, one is that if they have a prior credit history, they should not have defaulted.
Right.
So if they have defaulted, then clearly we stay away, because, and that everybody knows it, and frankly, it's a great thing because it helps us keep our portfolio great, because borrowers are very well aware that a bad bureau score and a bad bureau record will ensure that they never get money again. So that is again non-negotiable. So you cannot have cheated a bank, or cannot have not paid a bank, or not have settled with a bank,
right,
okay, in the past. So that's one clear thing. The second thing, especially for this segment, we look at is some anchor in the city in which they are borrowing. So we would like them to ideally own their residence or own the shop from where they are operating.
Why is that important?
So it prevents skipping. So skipping is when a borrower decides, hey, I don't want to pay back anyone, let me just lock up everything and vanish. And if they don't have anything permanent here, it makes it very easy for them to lock up and go back to their village. Not that we can't find them there.
Yes.
Okay, because
you have your checks and balances.
We
you
have
can
checks
if
and
you,
balances. We can if we wanted to, but just makes it that much more difficult.
Correct.
And there is a large number of people who actually have generational businesses, and in the generational businesses, they actually own the place where they operate from.
Right.
Some of them have their residents come shop. It's like one area where they have the residents at the back and the shop in the front. You've seen those,
yes,
in the city, and that happens. What has changed significantly since the time we started is the amount of turnover that has started going into the official banking channel. So we use the cash statement. We do cash flow based lending. So when we look at a bank statement, it tells us what kind of volumes of banking transactions go through.
Right.
And now we see, thanks to GST,
yes,
and thanks to the fact that a retailer would like to get input credit if they've already paid GST on what they've purchased from,
yes,
FMCG companies or
right,
whoever they are buying from.
Yeah.
They have to declare that turnover. So we are suddenly finding in the last 2 years that a good amount of turnover is coming in through the banking channels, and that's actually helpful for the sector, because banks can lend more. Banks will lend more, and I think the system will realize that and is already realizing it in some form.
Tell me, how much did demonetization actually help? Because when you talk about the informal sector, now that was a huge problem, and like you said, now that there is much more formalization of this loan giving activity, it smoothens the process to a certain extent, but also it kind of gets you that much going by way of an economy.
Absolutely.
But right now times are very difficult. So I'm just wondering, because I hear a lot of stories about many of them having packed up their businesses. Have you seen that?
So not in our sector. In our sector, we lend to those who supply you your daily essential items, which comes really low down in the list of items you would cut off from your consumption. You would start with the luxury items. You would start with cutting out things that are comfort items. You would not cut out on what you eat or what you have basic wear.
Yeah.
And
so these are Kirana stores.
These are Kirana stores. It could be a small eatery,
yeah,
where today the masses of India eat.
Sure.
Okay, where people who are the blue collared or even the white collared, they eat those places.
And they need these quick loans. Why?
They need the quick loans because businesses are growing, contrary to what if you say
because right now we are only talking about how businesses are slowing down. So.
Well, the businesses we lend to have all seen very good growth in the past few years, and that growth may have slowed down relatively, but there is growth. So we are not seeing like a drop in turnover. We are not seeing people suffering in the segment that.
Or have their outgoes gone up, and that is why they require the extra money?
No, not really. No, it's just that they needed to grow their business. We lend for working capital, and we are finding that. Coming back to demonetization, the interesting part of demonetization is, a lot of households are now paying through check to their daily consumption items, or there's prepaid cards, or there's Paytm, and all of that actually goes into the bank account. So while there might have been an initial pain for a short period of time post demon, it's actually resulted in a lot of the payments that are now going. Take my household, we pay almost everybody we deal with on a monthly basis through checks now. And everybody, even the milkman and the newspaper guy, takes a check these days now. Like, nobody wants cash because they're used to seeing checks in their account, and they realize even that's easier for them. So actually it's been I think a boon in the
And the GST setup has also helped, you said.
is also helped in showing more turnover on
Right.
the formal books, which helps them in getting a larger amount of loan.
Yes.
And helps us in actually assessing them better.
So tell me, since you were telling me about the kind of loans and the size of loans as well, what's the average ticket size of loans that are going out from you?
So for the shopkeepers, it's largely between 3 to 5 lakhs. We
Okay.
also do some trading manufacturing, which is in the slightly higher range of kind of 10 lakhs. So average is about 5 to 6 lakhs that we do per loan.
Okay.
70% of our loans are the smaller loans, which are between 3 to 5 lakhs.
Right.
Yeah.
So, and the average interest rate that you charge
So
on
again,
them?
varies on the profile and the amount of the loan. It could be anywhere between 19%, could go up to about 28, 30% per annum.
That's relatively expensive, isn't it?
So on the higher side, you may think it's expensive because the number seems high, but let's understand the fact that the working capital turnover cycle, the cycle is far quicker. You see your kirana guy, nothing will stay on the shelf for more than 3 to 4 days. So if I give them a 5 lakh rupee loan, I can assure you they'll generate 18 to 20 times turnover out of it, and they'll generate 1 crore of rupees of revenue out of it, and then you take a 5-7% margin. They've more than covered the principal amount of the loan in the first year itself, forget servicing interest. So people are very smart when they do their business. Nobody will borrow money unless they can actually turn it around and make a profit. Unlike in manufacturing,
yes,
where so when I say 19, that would go to a manufacturing company. When I say
sure,
24, 26%, 2% per month would go to a.
But like we also said that the competitive landscape is getting so intense that they have other options which may be cheaper. So then don't you need to be that much more cost effective?
So we are competitive based on the current landscape that exists, and also let's not forget that the processing cost and the unit economics of actually acquiring the loan and processing it is not like we're making a large amount of money. As an NBFC, we have our cost of funds,
yes,
and then on top of that we have our acquisition costs and our underwriting costs, and then some credit costs and that. So the margins are good, but they are not phenomenal like people misunderstand.
Would imagine.
Yeah, would
so
imagine.
Tell me about your costs and how you're able to control them. How do you see that getting more rationalized?
So there are 3 key drivers, right? One is your cost of funds.
Yes.
Okay, we are fortunate, like we are one of the only companies in our peer space to have been rated by S&P CRISIL, and we have a decent rating. So we've been able to raise debt even in a tough market. And so the cost of funds, what we get is reasonably competitive.
Right.
Okay. The other 2 drivers are your credit losses and your operating costs. So on the credit losses, we are very happy with what we've originated. We have a very low NPA number, and it's.
So where are delinquencies at right now for you?
So we are under 2% delinquencies.
I see.
Yeah.
Okay.
For the segment and the ticket size, I think it's pretty commendable, and we are happy to have done this. And like I said, people are not dishonest. Actually,
right,
it's not.
No, fair enough.
We've seen that by and large, this particular community is not dishonest. It's just you have to be able to identify the good guys from the not so good guys at the beginning.
Which your technology is able to do for you?
Which we are able to do at the underwriting level. And then the second is the operating cost.
Right.
I mean, we deploy a lot of technology in the mid office. We have a lot of proprietary technology which we have.
Yes.
For example, you can give me any piece of paper, which is a bank statement or any document that you give me, you could have eaten lunch on it, and I can assure you I can actually take that, digitize it, scan it, have machine learning, read it, pull out data, use AI to actually analyze your cash flows, and within 5 minutes give my underwriter a full summary of
5 minutes.
5 minutes. Okay. So we deploy a lot of that technology
Right.
in the mid office, and that helps us save the cost.
Yeah.
So as long as we are keeping our funding cost, our credit cost, and our OPEX in control, there's always margin in the business.
That's right. So technology wise, is it a one-time cost, or do you have to kind of keep replenishing
It's largely
that?
what we built is good for the next few years. It's
Okay.
just the upkeep now. But we're always innovating. We're always thinking of how do we move to the next level, because the world is changing.
Right.
People are changing. Thankfully, new generations are coming into the businesses that we lend to.
Yeah.
And so the propensity to use the internet and to use digital channels is high.
Yeah.
And so we have to start thinking and cater to that community as well.
I was looking at some data which is suggesting that loan against property is actually dipping now, and these are areas where you're seeing generally in the economy where there are pain points as of now. And so to be able to make your business model that much more scalable, to expand, you have to kind of go into the smaller towns.
Oh, we love small towns actually. So we have 15 cities we are in. Out of that, about 6 are smaller towns. We started with the larger cities, migrated to the mid-level cities, tier 2. Now we are in smaller towns and cities, and we like the business there actually. We find that it's a smaller community. and obviously competition is lower in that sense.
Right.
But everybody knows everybody, and people know each other well, and so the propensity to default is lower.
Right.
We can do loans quicker.
Right.
And the operating costs are lower. However, it's not everybody's cup of tea to actually set up shop and operate in smaller towns and cities. It could get difficult. I mean, we like that business, and as we grow in the coming years, you will see a lot of us in a lot of these smaller towns and cities of India, because they
choosing
are
to be there.
Choosing to be there
Works better.
Works better.
For
So
the
we are in
business.
Bombay and Delhi, but
Yeah.
that's no getting away from the fact
Correct.
that these are large markets.
Correct.
But we also love the smaller towns, like we are in Vapi, and we are in, like, you
Yeah.
know, you take a small town like Chomu in Rajasthan, and we are there.
Yeah.
Okay, so we do business there.
Also, in difficult times, Samir, I've noticed that there's that much more of partnerships that are forged. You see that across industries, and
Oh,
I'm sure it happens
absolutely.
in yours as well.
Oh,
I've seen that with an India Infoline, like joining hands with a Bear Juice. You know, you need that collaboration.
Collaboration is
yeah.
key. We work with a lot of collaboratives.
So how have you shaped
So
that?
we co-lend with banks.
Okay.
So some portion of the money that we have lent out is.
Which banks?
So we work with large private banks. We work with large NBFCs, and you know, they're good partners to us. They give us a good funding cost. It works well. It's a win-win situation. They will not get into the business we are in, so we give them assets that they would otherwise not originate themselves. So it's a good partnership that they work in. They like the assets we originate. We like them because it provides us additional funding, and that's separate and over and above what we raise.
How
as
much
debt.
of your business is that now? These partnerships, these kind of alliances?
So we do about 50-60% ourselves, and the balance goes through partners actually.
Oh, I see. And do you see that equation changing
Not
going
really,
ahead
no,
from
no.
here?
So it's largely stays
Because
there.
banks want to be able to access that, but
So we
except
could,
that
if
the
we
wherewithal isn't there.
wanted to, we could give everything to a bank,
Right.
and not have anything on our own books.
Right.
Banks are so hungry, especially good quality assets. I mean, this equation, I understand, changes very quickly. Okay, if
Right.
the NPLs were to shoot up tomorrow,
Right.
okay, we would be abandoned. Okay, so it's on us to make sure, if we want the partnerships to work, to have good quality portfolio, to collect well. So we do all the collections, so to collect very well, okay, and to have good quality underwriting. Of course, they will do their own assessment and have their own underwriter also look at it before giving the money. But that works well actually for us. And
So what's the end goal at this point in time? What are you working towards? Is there a lot of consolidation that you're expecting in the industry, and that you're setting yourself up for an acquisition at a sooner
it's early
date
days.
rather than
It's early
later?
days. Right now, I think we need to scale up the business
Right.
profitably. We need to grow the business, be in more cities.
I
grow
thought
the
you were
book.
hinting at that when you talked about making your setup as strong and robust, so that there is general interest from these banks who want this kind of
Well,
access.
who doesn't want a great exit? Okay,
Right.
now, how the exit comes is a matter of time. I mean, we are early stage still. We have a few years to go before that happens.
Right.
But let's put it this way: we will do something that banks don't do. Okay, and we will do things differently. We'll have our own proprietary technology, which would be attractive to whoever eventually wants to marry us. But right now, we are having fun doing what we're doing.
Well, we wish you great luck and
Thank
more
you so
fun
much.
in times ahead. Thank you so
Thank
much
you.
for joining us, giving
Thank
us insights into the fintech world. And this is, of course, a company that is all set to disperse 1,500 crore rupees of
Another
loans.
1,000 crores on
Another
top of
1,000
what
crores
we-
at this
in the
time
next
at least.
financial year, yes.
Well, great luck with that.
Thank you.
Thanks very much for
Thank you
stopping
very
by on Startup Central. Here's where we take another quick breather. Much more coming up on the flip side. Do stay with us.